So you're saying prior to 2001 or around 2001, when this bill passed, there was a benefit to getting married in terms of the tax, or there was a penalty?
There was a penalty of getting married.
Okay.
So if I could convince my clients to not get married and just shack up together, that was the best tax situation.
Okay.
But now at this point, it doesn't really make a difference whether you're married or not.
I see.
But it did back then. Interesting.
Okay.
Some of those other changes that we're having are, or the extenders, child tax credits. Well, if you make under a certain dollar amount, you get $1,000 of a tax credit. Not to be confused with the earned income credit. This is just a regular tax credit.
Okay.
And the earned income credit is going to be extended all the way through 2012. And these earned income credits, Eric, are almost $6,000. That means if a family of 3 are making under $24,000 a year, they can get $6,000 of a credit back from the government.
So explain earned income credit. I mean, is that essentially because you have income and it's under $24,000, the government's going to give you $6,000 as a credit towards the taxes you paid on that $24,000?
Good question. It's not necessarily just a credit. It's a refundable credit, which means if you had 0 taxes due, you can get $6,000 in your pocket.
You're kidding me. So wait a minute. Make sure I got this right here. So if a real estate agent who only made $24,000, he can get a $6,000 refund, not even having paid $6,000 in taxes.
Exactly, assuming he had 3 kids.
Okay, so he needs to have kids.
If he had 2 children, it would be $5,000. If he had 1 child, it would be $3,000.
Okay, so what if you have no kids?
If you have no kids, you've got to make under $6,000 in order to be able to just get a $350 credit.
Okay, so it looks like they need to go out and have some kids.
I guess so.
Get married and have kids. Right.
That's the incentive that the IRS is putting together so that we can all have kids.
Right.
So we got to get on it. Anyway, we have some of these I'm just going to run through really quick.
Okay.
It's just the same as last year.
Okay.
Adoption credits, the same as last year now.
Oh, okay.
Dependent care credits. That means that if you have your child in a preschool that has childcare, you can go ahead and have a credit against that. The American Opportunity Tax Credit. This encompasses what they used to call the HOPE and the Lifetime Learning Credit. That means if you go to school, higher education, anything above high school, that's a 4-year degree.
Okay.
You get a credit against your tax. So those that are in school right now can get a credit which potentially is refundable, just like that earned income credit. Of course, it's not as high as the earned income credit, but it's still something good that they can use.
Well, how much is it, John? I mean, for a person who wants to go get their master's, would that apply, or are you talking about just an undergrad?
Undergrad or master's.
Okay.
They can get up to $3,000 of a credit back.
Really?
That's a nice dollar amount.
That is.
Now, a lot of these credits phase out if your income is too high.
Okay.
So we'll have to look at how much they actually make in order to see how much they'll get a credit on.
Okay.
Some of these other extenders here are the student loan interest deduction. You can deduct the interest that you pay to Sallie Mae or whoever you're paying your student loans to.
Okay.
Here's a very, very important one. Payroll tax cut. They're gonna cut your payroll taxes from 6.2% down to 4.2% for all of 2011. That means that for you and I that are paying ourselves wages, we get a 2% less in Social Security. That means if you're making, let's say, the highest amount of $106,000, you would normally pay about $6,572 as far as Social Security. Now you're only going to pay, let's see here, 106 times 0.042. Now you're only going to pay $4,452. That's a credit of about $2,300 more in your pocket if you're making $106,000. If you're making, let's say, $60,000, it's more in the sense of $1,200 credit back.
Okay.
So you're actually going to get this in your W wage.
No, so this is for wage earners as well as, I thought this was just for self-employed people.
No, it's for both. It's for wage earners and for some individuals.
Okay, all right.
So the amount is a whole lot less. And mind you, we're talking about 2011, not 2010 that just passed.
Okay.
So other extenders and really neat things, 100% bonus depreciation for business owners. And gosh, we're all business owners here for the most part. If we go buy a computer, a laptop, or bigger machinery and equipment, we can write up to 100% of whatever we purchased as a full deduction in the year in which we bought it, regardless of whether it's brand new or used, which is a very big difference now. That means if we have a big manufacturing company and we buy, let's say, $500,000 worth of equipment, we can write it off all in the first year. That is really big. That's an incentive to go out and buy some more assets.
And that's for 2010 or for 2011?
2010 had a 50% bonus depreciation. 2011 has a 100% bonus depreciation.
Now, John, we're getting a little bit of feedback. Operator, are you hearing what I'm hearing?
Yes, it sounds a little bit cut off.
Okay, so I don't know, John, if it's I know you're using a voice over IP.
You want me to call back?
No. Let's see if it continues, and then if so, we may need you to do that.
Okay. Well, let me continue here.
Okay.
We're also increasing or extending the research and development credits. And the research and development credits are basically those that give you a credit instead of deduction for purposes of new equipment, new ideas that you have in your business. And some basic business ideas can be how to set up a better database system for all of your contacts. Those can be a credit, which is dollar for dollar back in your pocket as opposed to a deduction. Very, very powerful here. Now, this is only for 2011 and forward.
Okay. So the buying equipment in 2010, you can write off that year 50% this year, 100% this year. It's no depreciation over a period of time. This is 100% write-off now.
You got it. You got it. And could be very useful in this year. Here's a really important one. This one's been going around so much in our news here. The estate tax, which is basically what we call death taxes.
Okay.
When you pass away and you have an estate of greater than a certain dollar amount, you've got to pay Uncle Sam a certain percentage of that as taxes. Right. In the past, the amount was $3.5 million. So if you died with $4 million worth of an estate, you would pay taxes on the remaining $500,000 at 55%.
Wow.
Tremendous.
That's a lot.
Well, we had this really interesting anomaly in 2010 because the rules sunset. There was basically a free tax year in which no one paid any estate taxes on their 2010 estates of those people who had died in 2010. Some of these individuals that did pass away, some of the owners of DuPont, those bigger companies, billions of dollars in estates, didn't wind up paying 1 penny in estate taxes. So,
how did that happen again? Because it sunset in 2010 and there was no new law?
Exactly. So everyone was thinking, well, by 2009 we should be able to have a patch to this. In 2010 we won't have an issue. Well, there was so much arguments going back and forth, and especially with the struggle of Republicans versus Democrats in the House and Congress, no one came up to any compromise until the end of 2010 in December, when they actually compromised and said, okay, 2010 is gone, so whoever died in that period, they get a freebie. But anyone from 2011 and forward gets a $5 million exemption. Wow. And whatever they have above and beyond $5 million is taxed at the 35% rate.
Wow, that is fantastic. So up to $5 million and a reduction of, what is that? It went from 50 to
55.
Oh, wow.
So it's 55 to 35. It's an immense difference.
Yeah. So I'm surprised that Congress didn't make it retro, though, to get the DuPonts.
Yeah, we were all expecting it would be retroactive, but we were surprised to see that it wasn't. And, I mean, for some clients that did pass away in 2010, that was great for their heirs. There was no taxes whatsoever. In some situations.
Right. Well, that definitely would have been a time to be rich, huh?
Most
Rich and die.
Well, I mean, I would hate to die, but
right.
when it's our time to go, we got to go. But that's not a bad idea there. So that was the basics of our the Tax Relief and Unemployment Insurance Reauthorization and Job Creation Act.
Okay.
The next tax act here, and these are going to be a whole lot faster than that last one,
all right,
is the Health Care Reform Act.
Okay.
Wow, so much has been talked about as far as this is concerned. Most people are in the thought that, well, this is sort of like a health care for everyone, right? Not necessarily. When you look at the detail of all of the Health Care Reform Act, it's basically saying, hey, now that we have this act, everyone has got to get their own health insurance.
All right.
That doesn't mean that the government's going to pay for it. It just means that now the government is requiring you to have it.
Okay.
So this is an extensive issue here. What we want to take out of it for business purposes and for individuals is that if you have any employees in 2012 and forward, you are going to be required to have health insurance for them.
Really?
You're going to be required to pay a certain dollar amount of their health insurance.
Now, what about for in real estate where you have brokers who employ agents and, technically it's an employer-employee relationship? Is there a requirement there?
At this point, there is no requirement. But the IRS has been talking about this for over 30 years as to what the relationship between a contractor and the broker is. And more importantly, what's the difference between a real employee and a contract employee? I mean, those have a very thin line to cross there, and believe me, that line is crossed every day.
Mm-hmm.
So that's one of those things that you really need to talk to a tax professional about, or at least your attorney, as to whether or not the people who you're employing are really contract employees or if they're real employees. The Employment Development Department has been doing a lot of audits on this.
Okay. So if you are a broker and you actually have employees, receptionists, administrators, you are going to be required to provide health insurance in 2012. Not an option.
Exactly.
Right.
Exactly. The only silver lining that we see here is that there will be some credits based on how much you pay for the health insurance of these individuals.
I see.
Which will take a small bite out of what you're actually paying out.
Mm-hmm.
One of the biggest things that call it pork that was thrown in here,
mm-hmm.
and it has all of us in the accounting industry scratching our heads, is the 1099s.
Okay.
Right now, we've got a 1099 everyone that we pay more than $600 to for any services.
Okay.
Doesn't mean any products, just services.
All right.
In 2011, this changed to where all landlords must 1099 everyone they pay for services. Well, in the past, we didn't really need to do that. That wasn't a requirement. So if I pay my management company, if I pay my janitor or my gardener,
mm-hmm.
I've got to 1099 those. If I'm audited by the IRS and I don't show proof that I did 1099 them, the IRS could potentially negate my deduction.
Wow. That's huge.
So that's a big change. And that's happening right now. So if you do have any rentals, you got to make sure that you issue a W-9 in order to get that information from the payees before you actually give them their money. Because, if you pay them their dollars and you haven't gotten their information yet, believe me, they're not going to give you that information when they're about to prepare their returns.
Now, John, this is for 2010 or for 2011?
It's for 2011. Exactly. 2011.
Okay.
Yeah, 2010, same as usual. Nothing has changed as far as
Okay.
1099 reporting is concerned.
Okay.
2011 is the renters and the landlords. Here's the big one, 2012. We don't need to worry about this right now, but we do need to have this in the back of our minds.
Okay.
Is that in this Reform Act, Congress has said that we have got to 1099 everyone for not only services, but for products that we purchase.
You're
for
kidding
example,
me.
No, this is only for businesses, though. It doesn't mean corporations. It means any business.
Okay.
So that means that if we go to Target and we go out and get some supplies for our business, we have to 1099 Target.
You got to be
regardless
kidding
of whether
me.
it's a corporation or not. No, this is one of those things that it was really deep inside this Reform Act.
Okay.
And right now it's being